Folks, Jamie Dimon, the head of the largest bank in America and one of the greatest of all times, just laid out his prediction for the stock market for the next 6 to 12 months. And when I tell you, you need to hear this, you better listen up.
What do you think the future is for inflation and interest rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. The remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year. And I think the chance of inflation staying higher or rates going up are higher than other people think. So whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Now, basically, his whole thesis is that he's more pessimistic than optimistic about this market. And that's derived from 3 simple elements: inflation, geopolitics, and consumer debt. He thinks that these 3 elements are going to drag down the market long term. Now, he thinks that inflation isn't going to go down as easily and as fast as the current pricing in the market indicates. Basically, what he's telling you is that the current price action on the S&P 500, on the NASDAQ, it's all exuberant. It's all assuming that things are going to be a lot simpler than they are. And as a risk manager, because that's what a good CEO should do, and that's what a good investor should do, we can't ignore the fact that perhaps inflation isn't going to go down as simple as we expect it to be. And if that's going to happen, obviously the stock market will have a negative reaction. If the inflationary journey to 2% is going to be longer than we think, if inflation is stickier than we think, the stock market will have to adjust, because right now that is not priced in. And that's an important piece of information. As a risk manager, that actually makes a lot of sense. Now, he also talks about the geopolitical risks. And he's here again to tell you, look, as a risk manager, looking at what's going on in Europe and Ukraine and Taiwan, you can't just assume none of these is going to erupt in the next couple of years and send oil prices up. Again, if that happens, inflationary impact, stock market impact, economic impact, perhaps a recession, perhaps a stagflation, you can't ignore this. Now, he also talks about the fact that right now, stocks are super high because they've already priced in that we have soft landed the economy. Now, that hasn't happened yet. There's still a long ways to go. From 3.5% to 2%, it's probably another couple of years of journey. To assume that we've already arrived before that actually happened, it's a very dangerous assumption. And he also talks about this bias we have where we think we can predict when things will go bad before they do.
The future isn't predictable like that. So, I'm a student of history. I've watched all the inflection points. If you go back, and my dad was a stockbroker, I go back to the booming markets of 72 and the collapse of 74. The healthy markets of 80, the collapse of 82. The 87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before.
In 2000, 2008, even 2020, none of us knew the crash is coming before it happened. To assume that we will see this coming is such an arrogant thing to invest based upon or trade based upon.
I think the surprise would be higher rates because inflation didn't go down. That inflation has been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
So is unpredictability the new normal?
I think it's been the norm since my whole life.
Now, what he's saying is very simple. Even though this is not a probable scenario, things could go south quick. Inflation can go up. Interest rates actually might move up if that happens. Unemployment might move up. Geopolitics. A lot of things can happen that might lead the US to a stagflation environment for a couple of years. If that happens, the stock market will have to adjust violently downwards. And to ignore that, in a year where the geopolitical mess we're seeing right now across the world has never been worse, it's irresponsible as an investor. Now, let's analyze everything he said. On the oil front, if you look at crude is down from $94 about 9 months ago to $78. So that's good, right? Well, not exactly, because year to date, Since the beginning of this year, oil is up 8%. It's moving up. Same thing with inflation. We are much, much lower than the 9% peak we had in June of 2022. But we are now higher than the bottom we had in June of 2023. We went from 3% to 3.4%. So we're actually moving up, even though we're much lower than the peak. So both inflation and oil are not as bad as they used to be, but the trend is not good. The trend is actually slightly moving up. And that's something to pay attention to. Now, Jamie Dimon's whole theory is based on the idea is that the consumers are propping up this market with borrowed money, and eventually that borrowed money will run out, the economy will fall, and then the stock market will follow. If you look at household debt right now, it's almost at $18 trillion. Now, in 2020, we had $14 trillion in Q1. $14 trillion of debt. In 2008, we had $12.5 trillion of debt. So in 12 years, we've increased the household debt by $1.5 trillion. In the subsequent 4 years, from 2020 to 2024, we have increased it by $4 trillion. So in 1/3 of the time, we've increased the household debt 2.5 times. It's absolutely insane. The household debt is not something that's just going to go away. Households can't print money. It doesn't work like that. You have to understand that this increase in household debt will eventually come due. And that's already starting to show in delinquencies. Credit card delinquencies are going up in an alarming rate. Auto and credit card delinquencies are actually spiking in the fastest rate we've seen since 2008. And we all remember how 2008 shaped up to be. So in 2021, we had about 4% delinquency rate on credit cards. Right now, we're almost at 9%. Spending because of borrowed money eventually leads to repayment. At some point, this is the debt spiral we're all talking about. You get into a debt spiral, you can't spend anymore. Retail doesn't sell goods. They actually lay off employees. Those employees spend less. Businesses close. And eventually, profits and revenues of companies go down. Stock market pulls back. This is how the money glitch that we have right now, with everybody just borrowing endlessly, can eventually shape up to a recession. That's what Jamie Dimon is saying. And based on the data, he's not completely off. And if you look at gold prices, it also seems fishy. Right now, we have the highest gold prices we had in 12 years. Now, I'm going to be honest with you, not every time gold prices go up, that leads to a crash or a recession. But every time we have a recession or a crash, we did have gold spikes before. So the fact that gold prices are going up right now is another reason to pay attention. Now, on top of it, the stock market is at all-time highs on all fronts. The S&P 500 200-day moving average is 4,700. We are currently trading at 5,300. 42% of all S&P 500 companies are overbought, with only 14% oversold. We have done 13% returns on the S&P 500 in just 6 months. That is more than the average annual return of a good year on the S&P 500. Every single party I've been to eventually comes to an end, and this one is no different. Now, high valuations is another thing to pay attention to. Right now, the S&P 500 book value is the highest we've seen since the dot-com bubble 25 years ago. On top of it, the price-to-earnings ratio on the S&P 500 right now is at 25. Not to mention the fact that we've been inverted on the yield curve between the 2 and the 10 year for over 400 days. Every time those yields invert and they reinvert back, we get a recession. Now, we haven't reinverted back, but once that happens, that countdown starts. On top of it, the commercial real estate market is in shambles. Right now, we have 20% vacancy on offices. That's the highest we had in 20 years, especially when smaller banks with assets of $250 billion and below have an average exposure to real estate on the commercial sector of 23%, compared to 6% for the big banks. And we know that the smaller banks are in deep, deep trouble. Now, delinquency rates also are going up, spiking in an alarming rate that nobody's talking about. Everything is much, much more expensive than it was 4 years ago, and you're getting paid pretty much the same. Mortgage prices going up because interest rates are rising, and we have this massive snowball effect building up to more debt, more delinquencies, and basically a huge pressure on the consumers. Now, whether that leads to a correction, to a crash, to a depression, recession, whatever that may be, I'm not going to be here pretending like I know what's going to happen. But I will acknowledge that what Jamie Dimon is saying carries a lot of merit. On the basis of the facts we just cross-referenced, Jamie Dimon isn't wrong. He's warning you about a risk. Whether that risk materializes or not, we don't know. But the smart, prudent investor will mitigate and will manage that risk even if he thinks Jamie Dimon doesn't know what he's talking about. Now look, there's a few ways to mitigate such risk. Number one, if you are up big on some of your positions, you can take a third out. For example, you bought a stock 2 years ago for $1,000. And right now, this stock is worth $6,000. You have 6x your money. Great. Take $2,000 out. Put it on the sideline. Keep 4 in. Just as a risk mitigation policy. Another thing you can do is work on yourself mentally. Not to FOMO. Not to fall for this hype. Don't be one of them sheep who YOLOs into an all-time high market. Be careful. Don't mortgage your house and buy everything right now. Slow and steady. Dollar cost average into good companies, slow over time. In fact, slower now than if the market falls. And we teach that in our academy. I'll talk about that in a second. Another thing you can do, and we just had a great lecture about this in our academy just the other day, bonds. We had about a 1-hour lesson about bonds. Everything you need to know, it's on our academy. Bonds are a great way to acquire safety, to play defense. Now, the great part about bonds, if you buy some bonds right now and the Fed eventually reduces rates, you have just locked in a 5% in a much lower interest rate environment with zero risk. Adding some bonds to your portfolio in this scenario is actually not a bad idea. Now, as I just mentioned, we just had a massive lesson about bonds on our academy, patreon.com/Tom Nash. Join the academy. You can try it out for 30 days for free. Money back guaranteed. No questions asked. Go join, watch our lesson about bonds, and then leave. I don't mind. Just watch it because it's important. Now look, we just gave away $6,000 yesterday on our Discord. It's free to join, discord.gg/Tom Nash. All you got to do to enter our next giveaway that starts today is actually just participate. Comment, engage with the community, post reactions, post comments. Don't spam. We'll catch you and ban you. But join for free, discord.gg/Tom Nash. Become part of the community and participate in the next giveaway that starts today and will end on December 31st. It is 100% free to join and you might win a few bucks. So actually, those who left early never got to hear this, but you can actually join for free and you might win a few dollars. I'll see you in the next one.